So good afternoon, everyone. Namaskar. This is Brookings India. Welcome. I'm Shamika Ravi, the Director of Research at the institution, and this is our third development seminar of the month. We're very happy to have our own Distinguished Fellow, Dr. Rakesh Mohan, present his work on Indian monetary policy in the time of inflation targeting and demonetization. This is a joint work with Dr. Partha Ray. And our discussant today is Dr. Shankar Acharya. So you have a very illustrious group of speakers today. Dr. Mohan is a distinguished fellow with the Brookings India, and he's obviously the former governor of the RBI and currently deputy. I keep making, I think it's the third time I announce that. He's also a faculty at the university, Yale University currently, and one of our most prolific scholars. So welcome Rakesh, welcome back home. We're very happy to have you present this. Dr. Ray is at the Indian Institute of Management in Calcutta. He was also the director of the Department of Economic and Policy Research at the RBI, and I presume that's where a lot of these collaborations were struck. Dr. Acharya is honorary professor at IIM. He was the chief economic advisor to the government of India and also a member of the Prime Minister's Economic Advisory Council. Dr. Acharya's discussant will follow the presentation by the speakers. And Rakesh, the floor is all yours.
Thank you. Thank you very much, Shamika. As Shamika said, the joint paper with Professor Partha Ray, we worked together. We've been working together since 2004, I think, in different ways. Of course, since he was the Reserve Bank with me, the culture Reserve Bank is that they do all the work and I'm the front person. And we've continued that culture between Calcutta and Yale. So this paper has been done over a period of the last 7 months, 8 months or so, basically through the new communication network, so to speak. And I think this is the first time that since leaving the Reserve Bank in 2009 that I'm actually commenting on Indian monetary policy since I left. I should also mention that this paper was originally done for the Asian Economic Policy Review, who held a conference in Tokyo in April. And the formal, somewhat shorter version of the paper will come out in the Asian Economic Policy Review, I think, toward the end of this year or something like that. 2019 January. And this is sort of a full version in the sense that that's a journal article, so that's been shortened considerably, whereas this paper is in full form, so to speak. The structure of the paper, first just a very broad background on monetary policy in India, then a little bit more on the monetary policy in the new millennium, that is from 2000 to 2008. Then monetary policy in the aftermath of the NAFC, that is what people call the global financial crisis. I always call the North Atlantic financial crisis, because some of the West thinks that when they have a crisis, global. When Asia had a crisis, it was an Asian crisis, Asian financial crisis. So I always call it the NAFC, that is North Atlantic financial crisis. Then focus on the monetary policy after the taper tantrum and movement towards inflation targeting, and then some review of the recent monetary policy performance, and then specific comments on the demonetization episode, the NPLs, and Partha will talk much about the NPLs. We're talking much more about the NPLs, not the specific NPLs, but to some extent the impact on monetary policy. And finally, just a few comments on managing the impossible trinity, that is management of the exchange rate along with inflation, and just a few concluding observations. By the way, as you see, I'm not doing the clicking of this. Partha is an expert at clicking the presentation in time with what I'm speaking. So if there's anything wrong with that, it's his fault, not mine. But we've been doing this for a long time, so I hope it works. Okay. Just a very quick review of India's inflation record. And this is very important in a sense. That if you look at the period of the last little over 20 years, Indian inflation has essentially been in single digits, except the period 2009 to 13. And let me just note in passing that I left the Reserve Bank in June 2009. Things were pretty good till then, you know. And that is, so the point in some sense is that our inflation record for almost 15 years prior to 2009 had been in some other work I've shown that, was as good as any inflation targeting country. So very clearly the Reserve Bank had been focusing obviously on price stability, but along with many other things. Second, inflation has always been highly affected by exogenous trends, particularly in food and energy prices. And again, we'll come to inflation targeting later, but in India, people's inflation expectations are dominated by people's experience, particularly of food and energy price trends. And that in some sense is relevant for any inflation targeting framework. And finally, there are large differences between, in looking at inflation, until it's only since around 2014 or 2013 that we have the availability of an All India Consumer Price Index. So prior to that period, the only All India index was a wholesale price inflation. So even though the Reserve Bank looked at all price indices that were available, in most discussion it was WPI that was focused on, even though the Reserve Bank certainly looked at all price indices when doing monetary policy. And there's always been, there's often been a large difference between the wholesale price inflation indices and CPI, mainly because of the weighting of food and energy in the CPI is larger than in the WPI. So it's always the case that if inflation is being particularly caused in terms of the index by increase in food prices, the WPI is much lower than the CPI. So what this effectively means is that there's a difference between the consumer's price experience and expectation from producers, and therefore focusing on either one of those causes a problem in terms of what impact you're having on the economy as a whole. Those are just, I thought, a few broad observations on the Indian inflation experience and issues that you need to think about. I'll just also as an introductory remark, just said a little bit of the characteristics of the Indian monetary and financial system. This audience perhaps does not need it as much, but since I know that there are a number of people from embassies here, that may be useful. One, that the Indian financial system, of course, has been much more bank-based than developed economies in particular. Of course, the European financial system is also much more bank-based than North America. However, we've been working very hard at developing financial markets since the mid-1990s. All financial markets, equity markets, debt markets, derivatives, etc. So that financial market development is going on, but it was not much there before the mid-1990s. We've always had some degree of financial repression, and that continues to a certain extent. And I'm not necessarily saying that as a negative comment, although it does have negative elements in it. But we've always had a higher degree of financial repression in the 70s, 80s, till the mid-1990s. Financial repression has reduced, but they're still there. But to some extent, that may be useful for financial stability as well as price stability, and that we also always need to keep in mind in doing Indian monetary policy. Until the early to mid-1990s, we had a largely administered interest rate system, which got reflected. So in some sense, till the early to mid-1990s, the Reserve Bank didn't even have a monetary policy department. And the biannual policy things, what do they call credit?
Planning cell.
There was a credit planning cell, and the policy reviews were called what? Credit
policy.
Credit policy. So we didn't even have a monetary policy in the Central Bank of India till the early to mid 1990s. But there has been since the early 1990s with the economic reforms in general, gradual interest rate liberalization, which then could then start moving towards what you might call a normal monetary policy framework. And finally, again, a characteristic of the system which monetary policy needs to take account of is that we, of course, had a completely closed capital account just about till the early 1990s, and we've had partial capital account liberalization ever since. But the volatility of capital flows and the management has been a significant concern for monetary policy since the late 1990s. And this, incidentally, is now becoming much more recognized internationally as an issue that monetary policy, particularly in emerging markets, has to take account of volatility of capital flows. And the capital account management has now become, in some sense, respectable as possibly as part of monetary policy. And so the Reserve Bank has consistently done forex intervention in both directions, and we'll talk about that a little later. And we've had a managed but floating exchange rate since what? 1993. See, Shankar was chief economic advisor, so he did that. So I thought I would ask him to give the exact date. So these are sort of the very broad context in which Indian monetary policy works. Indian monetary policy has been framed, of course, as a consequence in response to these key features of the Indian monetary financial system. And until the recent inflation targeting framework, Reserve Bank was reasonably clear in saying that we looked at inflation, growth, economic growth, and financial stability all the time. The relative weights on each of those objectives, that is inflation, price stability, economic growth, and financial stability, varied over time. Of course, we didn't give numerical weights to them, but these policy statements tried to give information, make clearer which of those were a more important objective at any given time. And that kept varying. One of the consequences of that is that a lot of people in the commentariat, the media, the financial markets, felt that monetary policy was confused. Our view at that time was that it had to be, given the circumstances, and because we did, and we tried to, as Dr. Reddy used to say, we tried to share our confusion through our monetary policy statements, which used to be quite lengthy, actually. And of course, it was in Dr. Jalan's time, I think in 1998, when we articulated the multiple instruments approach. Therefore, we had, that unlike many other central banks, we explicitly said that we have a multiple indicators approach. We looked at inflation, we looked at growth, we looked at monetary and credit aggregates, we looked at the real exchange rate, and a whole host of indicators. And so we practiced multiple indicators approach and also practiced multiple instruments. And the multiple instruments included, first, of course, the policy rate. And the policy rate was that if one looks at the policy rate, it was mostly the real rate, that is the policy rate minus, in this case, WPI, because that was the only all India index available. Most of the time the real rate was positive, but not all the time. We also used the CRR regularly, depending on financial stability issues as well as liquidity issues. We use the SLR also regularly, taking it up and down. Also open market operations on a regular basis, again to manage liquidity in the system. The consistent forex intervention with sterilization. And also we used macroprudential measures much before they became known as macroprudential measures. Now, again, after the North Atlantic financial crisis, macroprudential measures have now become part of the arsenal of central banks. It's now explicit that central banks do that, essentially for financial stability objectives. But the Reserve Bank had been using those consistently much earlier, even though, of course, we didn't call them macroprudential measures. So we had multiple indicators, multiple instruments, and as I said before, therefore, communication was somewhat difficult. But the communication was done through a host of different activities, apart from the monetary policy statements or credit policy statements, through speeches and so on. and of course Reserve Bank publications. But nonetheless, given the sort of current framework of monetary policy making in central banks across the world, that where the communication is people want communication to be simpler and more direct, and in some sense more transparent. We always felt that we were very transparent, but because we were very transparent, people thought that it was not clear, because we were using multiple indicators consciously and multiple instruments consciously. So let me now come to the key features of the Indian monetary policy immediately prior to the North Atlantic financial crisis, that is 2003 to 2008. Key features: moderate inflation all through, high economic growth, almost 9% average during that period, very high forex intervention consistently because we were getting very high capital flows, and had to do a lot of sterilization. One of the important things that happened was around 2003, 2004, 2003 or thereabouts, that prior to 2003, there'd been, by our standards, very large for capital flows, and so sterilization has been going on, mainly through increasing the CRR, also through open market operations, by selling the Reserve Bank's stock of government bonds to soak up the excess liquidity. We saw in 2003 that the stock of the government bonds and Reserve Bank's balance sheet was going down, and we could see we were going to run out of them. And so I think one of the most innovative things was done, and this, I mention this particularly because this was, I would say, a remarkable example of cooperation between the government and the central bank almost anywhere in the world, in that the central government, Ministry of Finance, agreed to invent what we call the market stabilization bond, that is to allow the central bank, i.e. the Reserve Bank, to issue government bonds purely for the objective of sterilization. And they gave, what the finance ministry did during that period was to provide a limit to how much this reserve, to what magnitude of government bonds that Reserve Bank could issue up to some limit. And then they did not interfere at all in how much was issued. Of course, each had to be approved formally by the Minister of Finance every time they were issued, but they did not restrain the Reserve Bank in either direction. And I thought that was one of the most remarkable pieces of financial, monetary, and fiscal management, with 100% cooperation between the central bank, the Reserve Bank, and the Ministry of Finance. I have not yet come across a similar usage elsewhere in the world. There may be, which I may not be aware of, but this was very, very important for the liquidity impact of excess capital flows. As a footnote, we'll come back to that later, that because of the availability of this instrument, after demonetization, when all the cash went into deposits in the banking system was awash with liquidity. So the same instrument was used for liquidity management after demonetization. It's very interesting that you have an instrument which can be used for multiple purposes, and it's again a sort of very innovative instrument, illustrating the need for multiple instruments for monetary management to cope with different circumstances. The period of 2003 to 2008, the current account was mostly balanced during that period. Less than 2% of the current account deficit never exceeded 2% during that period. In fact, didn't exceed 1.5% of GDP during that period. There was very high economic growth, as I mentioned before, very high growth of monetary aggregates, very high credit growth, almost 30-35% a year during that period. As we were approaching 2007-2008, we did notice what we felt was excessive growth, for example, in mortgage finance and some other areas of lending. And so certain macroprudential instruments were used to curb those particular forms of lending. And I would say somewhat successfully. I've dealt with this in more detail in some other papers 10 years ago. But nonetheless, the point is that the kind of excesses that took place in some of the developed economies, which they didn't use such instruments prior to the North Atlantic financial crisis, we had started using those instruments to curb specific areas of excess, what we thought was excess. As footnote, I will also say is that we were asked at that time that how do you know how much to do? And the answer was we don't. That is to give a specific example of mortgage, housing finance, that in an urbanizing economy and with very high growth rates in income, you expect a very high growth in housing construction and therefore housing finance. There's no idea, there's no way ex ante that you can tell what is excess. Okay? Similarly, when you try to curb it, there's no way of a quantitative understanding how much to curb it. So all of that has to do with exercise of judgment, which was used. Some people might say not enough, some people might say excessive, but the point is that these instruments, that in the practice of monetary policy, which has financial stability as an objective, you need to look at all these things and then use all the instruments at your command to manage the financial stroke monetary economy. And certainly during that period, a great degree of financial stability had been achieved. And there was, as I think Partha will show later, huge improvement in bank balance sheets right through that period. Once again, you'll see that the bank balance sheets started deteriorating in July 2009, and I left in June 2009. Let me now come to a more important part of the paper, because that is all a review going up to the post-North Atlantic financial crisis period, which we divided into two parts, 2008 to 13, and then after 2013. So as soon as the North Atlantic financial crisis broke on September 15, 2008, there was a massive monetary stimulus and a massive fiscal stimulus at the same time. There were actually, I think, between the period of late September 2008 and I think, if my memory serves me right, in December 2008, if not a little longer, almost weekly meetings in Delhi involving the Prime Minister, the Finance Minister, the Deputy Chairman, Planning Commission at that time, the Chairman of the Economic Advisory Council, Dr. Rangarajan, and the Governor, Reserve Bank. The Governor, Reserve Bank, poor chap, Subbarao, whereas there was a phalanx of 4 or 5 heavy, powerful people, there was a young, new governor who was beaten up every time in those meetings every week to do more loosening of monetary policy. He, poor chap, used to then come back to Bombay and he would get beaten up by me as the deputy governor in charge of monetary policy, say, no, you can't do so much loosening. But nonetheless, there was a massive monetary stimulus. There was massive fiscal stimulus. There was indeed a very significant growth slowdown 2008-9. There was also a very massive capital outflow. In the month of October 2008, there was a capital outflow of about $20 billion. On one particular day, there was a capital outflow of $7 billion. Remember, I think it was October 23 or 24 or something like that. As a consequence of this, of course, the policy rate was brought down very fast towards negative policy rates, real rates. There was a large increase in fiscal deficit. One of the features of the 2003 to 8 period was that after the fiscal deficit had become very high in the early 2000s, like 2001-2, from 2003 to 2008, there was a consistent improvement in the fiscal balance because of this crisis, the North Atlantic financial crisis, plus I would say the impending elections in 2009. The fiscal balance was just lost in 2008-9, and then it continued a little later with a huge increase in fiscal deficit. And also during this period, apart from the very rapid decrease in the policy rates from something like 8.5% or something, I forget the exact number, to 3.25%. That was the lowest I think we ever reached in terms of policy rates. very, very rapid between, I think, September, October 2008 to, I think, March 2009 or thereabouts. In addition to that, because there was a fear of the financial system seizing up like in the West, even though it wasn't really the case, there was massive potential liquidity injection through a whole host of different means, which was not, most of it was not used, but the potential was around 10% of GDP in terms of the possible increase in liquidity in the system through a whole host of measures which are listed here. Now, consequence of all this was that indeed there was a very rapid recovery. So the 2008-9, there was a major slowdown. 2009-10, 2009-11, we had a very quick recovery. So the monetary and fiscal stimulus worked as far as that was concerned. And then, of course, that was followed by the slowdown. Now, a big consequence in terms of monetary policy was that we, after a long period of time, we had high inflation going up to double digits for almost 4 years. That is something that we had not experienced for a long period of time, actually. So it was really, I would say, a loss of monetary control over that period. Of course, this was also, this was among other things, apart from the monetary stimulus and the fiscal stimulus, there was a global increase in energy prices and other commodity prices, including food prices. And so, in fact, when people kind of focus on the very large increase in minimum support prices that took place during that period, which did contribute to inflation, it has to be recognized that the MSP was not inconsistent with the global food price increases. It was not just a domestic, what you might call populist response. It was somewhat consistent with also international food price increases. But food inflation was indeed partly induced by the MSP price increases, while remembering there was also international food price inflation. As I said, very highly accommodative monetary policy with negative real policy rates. The stance actually changed rapidly, that because of the impending inflation that we were seeing in early 2008, and particularly the oil prices started increasing, the stance till the North Atlantic financial crisis was actually somewhat contractionary. And so that was a sudden change after the crisis, which had to be done towards expansion of accommodative monetary policy. As I said, it was done very quickly. One thing that you need to note in looking at the charts is a very rapid reduction, like within 6 to 8 months, in policy rates after the NAFC, but very slow return to normalcy. Very slow return to normalcy. And that's to some extent when can be said that perhaps inflation had taken off and it was difficult. It took some time for the authorities to respond. And one interesting thing is that there was a significant increase in inflation expectations. And this is very important because, as it happens, we didn't have measures of inflation expectations until 2008. Yeah? And I can say this personally, I think Yashika will remember these discussions on inflation expectations, that we initiated this survey of inflation expectations, direct survey, asking people what are inflation expectations. There was a lot of resistance to starting those surveys because people said people don't know, they won't give an answer. So I had to even use 30-year-old experience, 25-year-old experience at that time, when I had personally gone around doing a household survey in Bogota, Colombia, on completely different issues. But I've been surprised by how much people know. So I said, look, I've done these surveys myself, I've only done one survey. But I said, I've done these surveys myself, don't worry, people know. And certainly I think that's been proved correct. You ask people, they give an answer. And there's no way of knowing, giving a right answer, wrong answer, whatever, but people give answers. And from the variation of the inflation expectations that come out from these surveys, you have to say that there's something in those surveys. And particularly inflation targeting framework, to the extent that in the inflation targeting framework, there's a lot of weight given to anchoring in that when central bank moves to inflation targeting framework, one of the arguments is that if I have a clear inflation target, say 4%, I'm convincing the public, financial markets, etc., that inflation will be 4%. And therefore, that's part of the inflation targeting mechanism, that even when there's a relative price increase by, say, energy prices going up or food prices going up, some shock, the theory in some sense is that people are still convinced that we have a central bank that is anchored to this inflation, and so in the overall price level then doesn't respond to relative price increase. And therefore, it's very interesting to watch what happens to inflation expectations. One of the other things that happened within 2009 and 13, that, as I had mentioned before, that we had that in order to manage the domestic liquidity, at the same time also looking at the movement of the real exchange rate and other indices of exchange rate, that there was very consistent forex intervention along with sterilization. Now, one of the very curious things of 2009 to 13 is that first, of course, the capital flows were negative in 2008-9 very heavily, but they recovered very quickly from the rest of the world. So capital flows then recovered after 2009, started 2010, etc. Also, what's also interesting is the foreign direct investment that remained pretty resilient and relatively stable. What also happened during this period was there was significant opening of portfolio debt flows. So the India had opened portfolio equity flows into the stock markets in the 1990s. But in my view, we had been correctly careful in not opening portfolio flows into the domestic debt market. That started being opened during that period 2009 to 13 with very volatile flows. And while the capital inflows were recovering after the financial crisis, we were opening our markets more and more and doing almost no forex intervention. So as a consequence, the real exchange rate was allowed to appreciate significantly till 2013, till the so-called taper tantrum. There was also, with the real exchange rate going up, there was unprecedented increase in the current account deficit to almost 5% of GDP. To my knowledge, I don't think we've ever had current account deficit as high as 5% before. Shankar, would that be correct? That would be correct. Yeah. That's why I have as my discussant, because he has all the information from earlier periods. So it was really quite unprecedented to allow the current account deficit to go up to almost 5% of GDP. And then, of course, there was the taper tantrum, that is the talk about reversal or normalization of US monetary policy by Ben Bernanke in mid-2013. And international financial markets got a jolt. There was, because of this current account deficit having gone up so significantly in India, the fiscal deficit had also been very high. There was sudden loss in confidence from the world. And this, by the way, is looking at other international experience, that this is this kind of pretty classic sort of sudden stop that takes place. And that's exactly what happened in 2013. Various observers included India in the so-called Fragile Five. There was outflow of capital during that period. And therefore, we had to do exceptional monetary policy and capital account measures in response. Again, there was, I think, a remarkable cooperation between the Finance Ministry and the Reserve Bank during that period. And I have to say that stabilization was achieved successfully and very quickly in this period, in this episode as well. And from 2013 onwards, there was a return of fiscal prudence. And from 2013 onwards, both from the previous government as well, of course, the current government, there's been a general practice, a return to fiscal prudence, which had been lost between 2009 and 13 or thereabouts. So that brings me to the fourth section, which is the era of inflation targeting. Raghuram Rajan became governor in September 2013 in the wake of the taper tantrum. He, for monetary policy, appointed the Urjit Patel committee, who's now the governor, to review the monetary policy framework, and that committee recommended a shift to inflation targeting and the appointment of monetary policy committee, bringing Reserve Bank in some sense more in line with international so-called best practice of monetary policy in the world. And inflation targeting was first appointed, what you might call informally, in 2014, and more formally in 2016 after the appointment of the Monetary Policy Committee. And of course, inflation targeting got a statutory basis through amendment of the Reserve Bank of India Act in 2016, and of course the Monetary Policy Committee was appointed. What is the record? Certainly, since inflation targeting was adopted, we've had low inflation. It has been helped, of course, by the low global energy and commodity prices, low food prices, partly policy-induced, correction consistent in fiscal deficit, and also real exchange rate appreciation. And also, since the adoption of inflation targeting, the real policy rates have indeed been consistently positive since 2014. So in that sense, it's been pretty consistent monetary policy since the adoption of inflation targeting. Now, if one looks at inflation expectations, you see the somewhat slow fall in inflation expectations. But what is interesting is that despite now what a 3-year or 4-year experience of relatively low inflation, inflation expectations have remained higher than what you might expect, which is a curious, I think this is an interesting feature of what has been happening. I believe it should, it needs much more work and research to try and understand why is it that people's inflation expectations hasn't yet got recalibrated with lower inflation, particularly low food price inflation, and of course low energy price inflation. And this, I think, is very relevant for inflation targeting framework on why is it that adoption of inflation targeting framework has not led to a faster recalibration of inflation expectations. Maybe it's too short a time, and people maybe are still not convinced. One curious thing here, if you look at the last couple of quarters, that curiously inflation expectations seem to be going up now, even though inflation only got a little marginally higher actually. So I would say these are worrying signs for the monetary policy makers and what's happening now. I would say that in terms of looking at inflation targeting, it's too early to come to a judgment on the success or otherwise of inflation targeting framework, because we've not had enough time. The global the global price situation has been pretty mild. The tests will only come when there are greater inflation pressures. Of course, because of there has been low credit growth at the same time. So efficiency of monetary policy is still an issue. We still need to worry about our monetary policy transmission efficiency in the sense that we continue to have a number of administered interest rates which are not in control of the monetary policy authorities. A good part, the transmission of monetary policy through financial markets is possibly still not efficient enough, even though we've been trying to improve our financial markets. So I think this is still an exercise that needs to be watched carefully and understood. One feature certainly I think that is very important, which we don't seem to have, as far as I can tell from public statements, we don't have a clear enough understanding that with an inflation targeting framework, how do you manage the external sector? That is, how much forex intervention do you do? How is that connected with the inflation targeting framework? What kind of exchange rate management do you do? How do you do it, again, connected to inflation targeting framework? One thing that is clear is that even though there has been Reserve Bank intervention in the forex market, there's been very significant appreciation, appreciation of the real exchange rate, And incidentally, during this whole period, export growth is zero, just when the global trade has been recovering in the last 4 years. So that's, I think, a major issue to my mind. We haven't quite, to my understanding, we haven't quite made up our minds how do you make inflation targeting consistent with also external sector management. And so can an IT regime, can inflation targeted regime, with an inflation targeted regime, can the central bank do exchange rate management? I won't say more on that on inflation targeting, but I think that it's, as I said, it's still an exercise going on. It'll take some time for it to settle down and for us to be able to evaluate how effective it is relative to the earlier multiple indicators approach. Let me now come quickly to demonetization. Partha will follow on the NPL side. As all of you know, there was unprecedented sudden move to demonetize currency notes of rupees 500 and 1,000 on November 8, 2016, which is about 86% of currency was withdrawn. The objectives were control of black money, that is tax evaded income, curtailment of fake currency, and attack on corruption. I'm not going to comment much on these issues because they're not so relevant to monetary policy. I'm going to consider monetary policy issues. Just a few data points. One thing very interesting is that if you look at the role of currency in the Indian economy and take a long view, so the ratio of currency to broad money, that is M3, has been falling consistently since 1950, at least, absolutely consistently. And it's come down to 10, 11, 12% by 2015. So in some sense, it's not easy to see why there would be concern on excessive currency in the system because it's coming down consistently. I have to observe, however, that somehow in 2016, there was some increase in the currency broad money ratio, which I have no understanding of. Maybe some people might have some observations. And I don't know whether that was something people had observed, therefore it led to demonetization. But certainly it is the case, one, that there had been a consistent fall, as you might expect in a developing economy, of the role of currency as part of total money in the system. And it's been absolutely consistent. At the same time, there's a little bit of a blip in 2016. Now, jumping to the present, the currency is back to the level of currency M3 ratio to what it was before demonetization. So in some sense, we're just exactly back to where we were before demonetization. And as you know, of course, 99+% of currency returned to the banking system. Now, of course, large cash depositors may be investigated by tax authorities. It might improve the tax-paying culture along with the GST, but certainly cash is back to the levels of pre-demonetization levels. Just a word on consequences, of course, there was huge economic disruption from November 2016 to mid-2017. There's definitely a negative impact on cash-based sectors. There may have been somewhat longer-term impact even on some particularly labor-using exports and garment, etc., which were heavily based on cash transactions, and then difficult to get back those contracts. Of course, there was universal inconvenience due to slower replacement of currency, lower economic growth, and also fiscal costs through much lower transfer from the RBI to the government. I would also want to make a comment that, as I mentioned before, that with this huge deposits of currency into banks, that banks were awash with liquidity. And so actually the Reserve Bank, I think, this is not commented on enough. The Reserve Bank has done a very admirable job over the whole demonetization period of managing liquidity with this huge increase in liquidity over this whole period, and then of course coming back to normality. Huge excess liquidity in the banks, very competent management Reserve Bank, use of course the liquid investment facility, reverse repo, etc., increase of the cash reserve ratio, but also, as I mentioned before, having the availability of the market stabilization bonds, that was again brought into use. And so in fact the Reserve Bank has done a quite remarkable job, I think, in managing liquidity as a consequence of demonetization. So I will just make one final comment. The final assessment, I think, of the desirability of demonetization and its impact still remains in balance, but I would state a fundamental objection as a former central banker. The debasement of currency is never desirable. It should never be done. Debasement of currency. Debasement of currency only happens when you have infinite inflation, like in Venezuela or Zimbabwe, or in times of war. One is not able to find any example of debasement of currency during normal times. And when I take a piece of paper which says 100 rupees or 500 rupees, 1,000 rupees, why do I believe it's worth so much? Because of trust and nothing else. When I speak on this in the US, I always fish out a US dollar note and I ask people to turn the dollar note and see what's written behind. It says, "In God we trust." So I often say in the US, you can never have demonetization because you have higher authorities to appeal to. Partha will do the NPL.
This is not a paper on NPL, but we will look at some monetary policy implications, perhaps. Just to begin with, as far as non-performing assets of the Indian banking sector is concerned, initial late 90s, people realized, and there was huge deterioration, but things have really started improving from early 2000 till about March 2009. From there, it looks absolutely like a U-shaped curve, as if we are worse than where we have started from. And that's a matter of concern. There are various things can be pointed out why this came up, the genesis of the problem. We didn't, this is, as I said, this is not a paper on NPA. Our initial research dictated us that there were 4 broad factors can be pointed out. There was initially regulatory forbearance that Dr. Mohan already talked of after the NAFC. There was indeed globally sharp fall in commodity prices like steel industry in India, number of them suffered because of bad global prices. There was indeed aggressive government promotion of PPP projects, infrastructure. And finally, indeed, there are governance issues. The reason we are showing this 4 together, we in our mind not clear how much is each factor responsible, but to say everything is because of number 4 is clearly not correct. Perhaps all 4 are responsible in some sense. Number of things they have done, again, we are not here to talk on this, maybe a later paper we might discuss there. But one thing indeed looks like, again, symptomatically, did it dampen the credit growth? Mohan earlier had an expression called lazy bankers. Will this current governance issues coming each day in the front page of the newspaper, will it make bankers lazy so that you are flush with deposits, but the best thing is to put them all in excess SLR, I don't care for the credit growth. Now, here there is clearly an identification problem, whether there is a credit demand or credit supply issue, but from the standpoint of bankers, really the credit growth did not take place, and that's not necessarily a very good thing. In this, I'll now turn again to Dr. Mohan to talk on the impossible trinity.
I'll be very brief because I think I've got 5 more minutes or so in terms of time of 1 hour given to us. As I said before, in particularly emerging market economy, given the volatility of capital flows in particular, it is indeed very important to both have a manage the exchange rate and of course through forex intervention. Now, having said that, at any given time you can never know what is the appropriate exchange rate. That is, so certainly the Reserve Bank, to my knowledge, since the mid to late 90s, has never had an exchange rate target. Nonetheless, it has managed the exchange rate and done forex interventions. So what you want to do really is a floating exchange rate, but given the circumstances in emerging markets, you do need to manage it. What you can observe here, of course, is that particularly in recent times, the real exchange rate has really increased considerably by something like 20%. And as I said earlier, that one of the consequences of this is, one of the possible consequences of this is zero growth in exports over the last 4 years. Also, the industrial growth in the country has been low, lower than one might expect. Obviously, if you have a highly appreciated exchange rate, foreign goods become cheaper, and so domestic producers who are producing for domestic market also get affected. And so the overall growth rate becomes affected. And this is kind of important to think of in terms of monetary policy framework, is that if you have inflation targeting and you don't have growth as much in your minds as you would if you had a multiple indicators approach or multiple objectives approach, then even though yes, it's in your mind, but you don't give it as much attention, also to the extent that you want to keep inflation, that inflation is a target, you're happy with the real exchange rate appreciating. And so this is a real conflict, a real tension, which to my mind we've not resolved, and we're seeing some of the ill consequences of this as far as I can see. There was significant intervention by the RBI during 2013 to 2015, and it has reduced since that time. Again, I don't know any discussions on this, whether it's a government policy, whether it's a Reserve Bank policy, it's a joint policy, I really have no idea. But certainly the data pretty clear that the intervention is much higher in the 2013 to 15-16 period and much lower since then, and of course the real exchange rate has appreciated significantly. There's not enough time to go into this in much detail, but I think that this whole issue of the impossible trinity, that I've always maintained that you can manage the impossible trinity, which of course may be a contradiction in terms, that what you want is an independent monetary policy, which I think we have had. 2, you can manage the exchange rate, but still let it float. So you don't have to be the corner or a complete float. You want it float, you want market indications of what the exchange rate ought to be, but you need to be very cognizant, particularly of capital flows, because those are very volatile. And third, of course, none of these you need to be at the corner. Similarly, you can have substantial capital account convertibility, which we do. And in fact, if you look at capital flows, gross capital flows as a proportion of GDP, they're not very different from the United States. So you have substantial capital account convertibility, but not 100%, because you still need to manage the capital account, and particularly portfolio debt flows. In the taper tantrum, when there was a huge outflow of capital, interestingly, most of it was from the portfolio debt market. Very little equity went out, actually. And somehow we don't seem to have learned from that, and we're making the same mistake today, if I may say so. So I just say that on the impossible trinity to make the point that in the Indian or emerging market monetary policy framework, external sector management has to be an integral part, and it's not clear how that is consistent with inflation targeting framework. Okay, so let me just conclude, as I said, some conjectures in lieu of conclusions. To summarize, in retrospect, I think it's clear that following the NAFC, the monetary policy was excessively accommodative and prolonged longer than warranted. Let me say very clearly that it needed to be accommodative in the wake of the crisis. There's no question about that. The question is how much. And I think in retrospect, it was perhaps excessive, and also that the restoration of normalcy was too slow. And of course, this was accompanied by excessive fiscal stimulus as well. Of course, and I do believe, of course, that given that inflation experienced double-digit inflation during that period, that gave rise to the adoption of inflation targeting. It may not have happened. Of course, that's a counterfactual. It may possibly not have happened, but in the wake of that inflation surge, it became sort of, you in some sense had to do it. As I said, the inflation targeting framework in India is still in its infancy. I do think that this has to be watched carefully, and I think the authorities need to think about it more in terms of how to practice it. One difference, by the way, in the Monetary Policy Committee as constituted here and in the major central banks, in almost all the major central banks, the Monetary Policy Committee or equivalent is all full-time people. Here we have part-timers. Of course, they're very good part-timers, but it is certainly the case, having worked as a bank, that no one who's part-time has the kind of information that full-time people have. So even at the Bank of England, for example, which has always, I think, 3 or 4 so-called external policy, monetary policy MPC members, once they become members, they have to be full-time, and they have to leave everything else that they do for that period. So this is one difference that we have, which I think also needs to be thought about. So it remains to be seen whether how the IT framework, innovation targeting framework, will weather the that typo there can't wither. Maybe there's a Freudian slip. It remains to be seen how the IT framework will weather rougher times to come. Demonetization clearly created certain significant real economy problems. It's nice to see that the central bank was indeed equipped with measures that could manage the monetary and liquidity impact. Biggest problem in the Indian economy, financial sector, is indeed the huge increase in NPLs. A big improvement that has indeed taken place is the enactment of the Insolvency and Bankruptcy Code, which should have been done 20 years earlier, but wasn't, and this government has done it. Again, it remains to be seen how successfully we do, but I do believe that this is the biggest problem today, slowing our growth. And the more quickly we can take the bad loans out of the banks and let banks function, the better. And of course, finally, the Indian monetary policy continues to face tensions of the impossible trinity, which I've tried to illustrate on its impact. So I think I took exactly an hour, Shamika. Thank you very much.